Hi, everybody. Matt Watts with Icon Mortgage here, or as a lot of people refer to me, Mortgage Matt. Today, I want to talk to you a little bit about refinancing, when you might want to, and what type of products might be available for you when you do. First, the absolute most important part when you're considering refinancing is to discuss with your loan officer what your goals are. If you are in the position where you just want to lower your mortgage payments so you don't have a lot of other debts, or you have a very high interest rate on your current mortgage and you just want a better monthly mortgage payment, then that is what we would call a simple refinance. So in other words, you're just trading one mortgage for a new mortgage. And in that case, there's not a whole lot of variation to it. Chances are you just want to find out what type of loan program you can get qualified for. In most cases, a conventional loan will be the best. If you have some credit challenges, you can refinance with an FHA loan. So there is that. If you already have an FHA or rural development loan, in most cases, you'll probably be better off refinancing into that same type of loan, depending on how long you've had the loan. And most importantly, how much equity you have in your current home. So if you have, say, an FHA loan and you have had it long enough to accrue more than 20 to 25% equity in the home, chances are you want to use that opportunity to refinance into a conventional loan to get rid of mortgage insurance altogether. And not only will you save money on the interest rate if you can get a better interest rate, but also by eliminating the mortgage insurance as well. Conversely, if you've had your government loan, FHA or rural development or VA for only a short period of time, and you haven't accrued a lot of equity into it, then you may want to lower your interest rate and payment simply because interest rates have gotten better, but you are not going to be able to get rid of the mortgage insurance. And so in that case, you're probably better off sticking with that same loan type and doing what we would call a streamlined refinance. A streamlined refinance is when you already have a government loan and you're refinancing it into a new government loan. Well, they generally make those pretty cheap and easy for you to do. There's not nearly as much hassle in the underwriting and etc. as long as you've been making your payments on time. Now, there are still closing costs involved because you're getting a new loan, and there, in some cases, depending on how you work it, you may even have a little bit of money you have to bring out of pocket. But when the time comes that interest rates are better, you'll just have to assess the benefit because chances are it'll be worth it to stick with it. Well, from there, really, the next question would be whether or not you simply want to refinance your mortgage into a new mortgage, or if you want to tap into the equity to pay off debts, make improvements to the home, or whatever you may want the money for. So in that case, we would call that a cash out refinance. So you own a home for $200,000. That home is now actually worth $400,000, and you want $100,000 in order to add an addition to the home. You can do that. Whereas with a simple refinance, probably the most important thing is to time out the market correctly to get the best interest rate possible. With a cash out refinance, that's not really the case. In fact, there really would never be a bad time to explore the option of a cash out refinance. With a cash out refinance, where you're using the equity, that is not nearly as important. And in fact, chances are it's not important at all. It really only matters how the new loan fits into your total financial picture. You can still save money overall by looking at a cash out refinance. Or if you're looking for the money to improve your home, that again is not as important with the timing because the consumer credit that you would take out in order to use for those home improvements, if you don't have the cash in hand to pay for them, is going to be far more expensive than the mortgage that you would take out for that money. Those credit cards that you pay $200, $300, $600, $700 a month on, you're not actually paying them off. You're not actually whittling them down. You're just paying the very minimum. You're paying all financing charges. You're paying 25% interest on it. It's just not a good situation. And the timing is not as important. It's more important to go through all the numbers with your loan officer to make sure that you have a complete picture of how this affects your financial long-term health. So refinancing may or may not be a good idea for you, depending on your timing, depending on your goals. My advice to you would be to simply reach out to a high-quality loan officer and listen to what they have to say to you. If you'd like me to be that loan officer, I can, of course, do that. Only in the state of Michigan, though. My telephone number here is 810-919-8138. I'm always happy to have a conversation with you. Or you can just tap the Apply Now button in my menu in my website. Thanks.